financial resolution. Deposit Insurance Bill of 2017. See, the basic criticism, these days you might have gone through too many articles, okay, criticizing that this particular bill is going to have an enormous impact on the depositors. Depositors' money would be washed away. Modi is taking all this money, isn't it? So this kind of criticism, that is something you might have come across when it comes to this bill. The reason is simple. It has introduced something called bail-in, replacing this word called bailout. The practice of bail-in is the major criticism. Okay, and the second practice is simply simply abolishing DICGC or simply merging with an agency called Resolution Corporation. So what is also bad about the way media has propagated? You get it, friends? Generally we have this English media, okay, print media and both the electronic media, isn't it? An anti-development media generally. They understand very few things, but they try to exhibit as though they are the one who knows everything on it, isn't it? So other than speaking good English, most of these people in English, media, they really don't understand what is what of either economics or science, isn't it? So what exactly is the provision in this bill? See, here in this case, the bill is meant for resolving financial institutions which more or less experience the same problem like the other investor who has invested money in a business is experiencing. So addressing the basic issue of non-performing assets. Agar if they have very bad balance sheets, how to clean up the assets, how to clean up that particular bad balance sheets and how to overcome the problem, and if at all they experience the same problem of insolvency and bankruptcy, how are you going to resolve these particular financial institutions? Like we have an insolvency and bankruptcy code for those institutions, or sorry, for those industries or for those companies, okay, which I have given an example. Similarly, when it comes to resolving the issue of insolvency and bankruptcy of financial institutions, we have a separate law proposed. Okay, we have a separate law proposed which is under the consideration of Joint Parliamentary Committee. It has not yet become an act. It is still under the consideration of Joint Parliamentary Committee. The proposal here is simple, is to come up with simply a bill, and the existing mechanism, what do this particular bill has, the basic provisions of this bill is simple. As of now, my dear friends, you might be knowing, okay, many of you might be aware, every deposit, the amount of money you deposit in the bank is insured by an agency called Deposit Insurance Credit Guarantee Corporation. As of now owned by RBI. There is an agency insurance company like an LIC, life insurance ke liye, isn't it? Like you have health insurance companies. Similarly, there is a company which insures your deposits. Okay, deposits that you have just parked in a bank. The maximum money that is insured, your money is insured up to a maximum of rupees 1 lakh. Okay, in case of a bank itself becoming bankrupted, in case of a bank itself being liquidated, okay, in case of bank being bankrupt or liquidated, what would be the amount of money that you will be receiving in the name of insurance is to a maximum of 1 lakh rupee. Doesn't matter you have 100 lakhs as deposits or 20 lakhs as deposits, the maximum money that you are insured up to is 1 lakh. And who is that insurance agency? Deposit Insurance Credit Guarantee Corporation. This company is the one who is going to pay you 1 lakh rupees of insurance on the deposits you make. Doesn't matter how much you deposit. Okay, if it is 100, you would get 1 lakh, pakka. But if it is more than 1 lakh, okay, it doesn't matter whether it's 100 lakhs or 200 lakhs or 20 lakhs. The maximum extent of insurance that you would be able to receive is 1 lakh in case of liquidation of the financial institution. Like any other agency, any other investor, even the financial institutions would also experience the same problem of insolvency and bankruptcy. So in order to address this basic issue, the government has mooted this idea, FRDA. So what would the current provisions of this FRDA bill is simple. Once the FRDA bill comes into picture, the government idea is to come up with an agency called Resolution Corporation. Resolution Corporation. And once the Resolution Corporation comes into picture, it would take over this existing insurance company. So once this Resolution Corporation comes into picture, there would not be any Deposit Insurance Credit Guarantee Corporation of India. So that company would be closed, and that would be part of Resolution Corporation. Following, so you will not be having any guarantee of repayment of your instance. You getting? That's it. So this is the basic idea coming with this Resolution Corporation. And what does this Resolution Corporation does? What's the basic responsibility of this Resolution Corporation? Is simply to analyze these financial institutions. Because if you look at, my friends, different financial institutions, different kind of financial institutions in India are regulated by different regulatory authorities. If it is banks and NBFCs, RBI. If it is stock markets, SEBI. If it is pension funds, PFRDA. If it is insurance companies, IRDA. So each and every financial institution is being regulated by different regulatory agencies. They have their set of rules and regulations. They have their own guidelines. And if there is a problem of deterioration asset quality and the liabilities increases, how are you going to resolve? You have too many laws dealing with it. Now to overcome such kind of problems, this fellow has proposed Resolution Corporation. What do this Resolution Corporation will do? Is simply take over this company DICCC, and the business of Resolution Corporation is to look after how the performance, the performance of financial institutions, how these financial institutions are performing. So look at the performance, evaluate the performance of financial institutions, analyze their performance and figure it out if they are exposed to any risk of failure. So simply instead of having too many regulators, like this Resolution Corporation would be the one who would be looking after how various financial institutions are performing, and analyze if there is any chance of or any risk of failure of any institution. For that matter, it's not only bank, either an NBFC or a mutual fund company or any other financial institution, figure it out if there is any risk of failure. If you find out any such kind of risk, take certain corrective actions. Take certain corrective actions to overcome that kind of risks. And at the end of the day, based upon the risk of exposure, based upon the exposure of exposure to risk, this particular Resolution Corporation would be categorizing these institutions into 5 different categories. One with low risk, moderate risk, moderate, material, imminent, and critical. So someone who has to be sent to ICU. So based upon the exposure of these financial institutions to the markets, based upon the risk of exposure, so what happens? This particular Resolution Corporation would rate these particular institutions in 5 different categories: low risk, moderate risk, material risk, imminent risk, and critical risk. Once a particular institution has been rated as critical, that's where the Resolution Corporation would come into picture and do the same thing like what the insolvency professionals are doing. Do something to ensure this particular financial institution would be resolved, so that this particular institution would not be bankrupted. So as part of resolving such kind of institutions which have been rated critical, the government, as part of this FRDA bill, has come up with a provision. That is, in general, the very common practice in India, whenever you experience a high risk exposure of any financial institution, the basic practice is bailing out. But here in this case, as per the FRDA bill, the proposal is, instead of bailing out with public money, instead of using public money for the sake of sustaining or supporting this bank, why not use the depositors' money? How come convert the depositors' money into equity? Why not explore an option of converting the debt? The depositors' money is a obligation on the bank. Why not convert into equity? Or why not ensure certain debt would be written off? Simply make an agreement with the depositors. Instead of 100 rupees repaid, let's settle for 90 rupees. Just imagine. So this particular Resolution Corporation would do everything possible, not with the support of taxpayers' money, with the support of the bank owners and the stakeholders of the bank and also the depositors. So everything happens within that particular core group of bank. That would be as part of the depositors, the stakeholders of the bank, and simply the one who is managing the bank, but no external support would be extended. As part of this resolution, okay, resolving this particular financial institution, how much money one has to be paid? Because imagine in the worst case, the bank is going to be bankrupted or the bank has been going to be liquidated. In such case, in general, every insurance, every depositor is being guaranteed up to 1 lakh rupees of insurance. But how much money each depositor would be getting in the worst case of liquidation of bank? As of now, this bill has not specified any limit like 1 lakh or 2 lakh. It has left the option to the resolution corporation how much one should get. In the case of worst case of liquidating bank, how much each deposit holder should get. Instead of 1 lakh for every person, okay, whoever had deposit of more than 1 lakh or 2 lakh, it has been left. The decision of paying back to the depositor has been left to resolution corporation. It has not clearly specified only 1 lakh rupees would be paid. It has left the decision to resolution corporation. If he thinks he can pay more, or someone who has deposited more, let him get paid more. In such case, the decision has been left to resolution corporation. So no more guarantee or no more backing of come se come 1 lakh rupees of insurance against your deposits. So who is going to decide? Ultimately resolution corporation. And how is this bank is going to resolve the basic problem of insolvency? Is not with taxpayers money, is with the acceptance of the stakeholders of the bank itself. So simply ask your deposit holders, you have deposited too much of money, but unfortunately I have made some wrong business with this money, but unfortunately he has not repaid and everything has been converted to non-performing assets. All my assets have been washed away. In order to sustain the bank, you should support me. How come? One solution, okay, you all deposit holders become the shareholders of my bank. That is one solution. Or instead of getting 100 rupees paid repaid, okay, why don't you accept some 90 rupees? This is one solution. Or simply merge this bank. If at all you all accept it, shareholders of the bank, you all accept it, I'll merge this bank with some other big bank. Ready, my friends? So this is how the resolution corporation is going to resolve the aspect of insolvency and bankruptcy. Okay, my friends, the reason why the bill is being so highly criticized is simple. Previously, come se come at least 1 lakh has been guaranteed by law. But now the decision of how much money you would be insured has been left to resolution corporation. Maybe the resolution corporation at the time of winding up the bank, liquidating the bank, might end up paying more than 1 lakh, less than 1 lakh, isn't it? That is something not guaranteed as part of bill. Second provision is until this point of time, taxpayers' money is being used to sustain the bank. Now, abhi the onus of failure of a bank would lie on those people who believed in the bank and deposited money in the bank. Is it not? Since it is you believe the bank, okay, in case of the bank exposed to failure, exposed to risk, you should bear the risk. You get me, friends? It's as simple as that. Why did you go to a bank? You are anticipating the bank would be paying some amount of money as an interest. It's as simple as that. You are lending some money to some agency. If you believe, if you have the gut feeling that this particular agency would never default, would never get bankrupted, in such case, you have to be the one who has to take that particular risk of depositing your money. But you should not expect. It doesn't matter to me which bank I keep my money, but at the end of the day, the government is going to ensure my money would be safe. Following, my friends, so these are the basic two clauses within this bill that has created huge furor. Okay, so some people started analyzing the government and Mr. Modi and Mr. Jetli looting money. So whatever is the comment, at the end of the day, the government has come down and ended up saying, agar if it is a public sector bank which experiences such kind of situation, I am guaranteeing, okay, the bail-in clause would not apply for it. Okay, the government came down to such an extent and ended up accepting, agar if the bank under consideration is a public sector bank, I would ensure this clause of bail-in doesn't apply for it. To be frank, as of now, with the prevailing conditions in this economy, who really should not given this option of bail-in is the public sector banks. Because private sector bank, they already has certain kind of imminent discipline, because if your bank doesn't run, you will be the one who lose jobs. If your bank makes better profits, you will be the one who is running the bank is the one who gets better incentives. Public sector bank mein, that's not going to exist. However you perform, however you work for your bank, doesn't matter. Every bank, irrespective of its risk exposure, they all end up paying the same interest rate. Isn't it? They all end up paying, giving the same incentives. So the reason why there would not be any competition and why they take it into granted, simply their blind belief that it doesn't matter to me how I run a bank. At the end of the day, I have my owner who is going to recapitalize my bank, using to bail out my bank. That's the basic reason. It has been the practice not only in India. This is something, not a new innovation in India. This is a practice in most Western countries. It's as simple as, now let's say I have come forward a proposal to you. Said, my dear friends, why don't you give me some money? I'll make business with this money and I'll pay you certain amount of money as dividend. If you end up believing in me and simply lending money to me, believing, the overconfidence that you will be getting enormous amount of dividend irrespective of knowing the credentials of my company, what am I doing with your money? You getting my friends? So the owners are simply, the responsibility lies not on the government for the mistake you and me committing. It lies on the one who has blindly kept the money with it. But generally that is something to do with the business. But here in this case, hard-earned money of the common man. I approach a bank accepting or believing the bank would never default. But this process of bailing out, irrespective of the practice of the bank, simply persists for a long span of time. The banker would not be having any discipline. There would not be any reward for the banker. Now if the deposits get to know, if the bank gets liquidated, it is my money who is going to be washed away. In such case, people also start rethinking when it comes to depositing or when it comes to selecting a bank in which they need to park their money. So how do people take decision when it comes to parking their money? They would be taking decision based upon which bank is the strongest bank and which bank has the least exposure to non-performing assets. So it does mean, those bankers who command such a huge faith in the markets are those banks who can raise cheaper money, because people have trust, faith on such banks, so they can make better business. For that to happen, banks should take care of how to run the bank by themselves, but not depending on public money. Right, my friends? That is the idea behind bringing in this clause called bailing. But if I simply say it doesn't matter, however you write your prelims examination, the government is going to add up 50 marks irrespective of your score. So obviously what you need is 115. The government is guaranteeing 50 marks. So you only, so previously until this point of time, you used to target for 60 questions out of 100. But since the government has made guarantee that 50 marks would be added to students of this particular institution, so what do we end up doing? 115 ka target would come to a target for 65, because rest of 50 government takes care, isn't it? So that is the same basic problem when it comes to this banking sector. You get it, friends? And that is what is all about FRDA bill. Any doubt? Yes? So this is something to do with the twin balance sheet problem, insolvency and bankruptcy code, and then the FRDA bill, strategic debt restructuring. I have discussed almost whatever, and the recent change and the recent amendment. So just not more than a week back, it's hardly 3-4 days, the RBI has given a statement, no longer this particular strategic debt restructuring, S4A, joint lender forum would be the mechanism to ensure recovery, isn't it? No longer they would be in practice. That does mean the government is seriously contemplating to ensure FRDA would become a reality. And this is the practice in most of the Western countries.